Well, time for this week's Wealth Feature with the CEO of Cannon Asset Managers, Dr Adrian Saville. Evening, Adrian. How are you doing?
Evening, Michael.
Warren Buffett once said that investing is simple but not easy. And given his love of cheeseburgers and Coke Light, and also being, I think he's 88 years old this year, he might not agree with this analogy, but I've compared investing to getting healthy. Being healthy is simple, but it's not easy. We all know that if you eat right and you go to the gym, you'll get healthy. It's simple, but it's really hard to avoid cheeseburgers and maintain the discipline to hit the gym every day without just swiping your card for the discovery points. And one of the first principles in investing is also to buy low and sell high. A second one is obviously the inverse, to avoid buying high and selling low, which again sounds deceptively simple. But it's not easy. Why are we so monumentally bad at this one golden rule of investing?
It's the behavioural wiring. And your reference to the burgers versus the gym is instant gratification. That it is much easier, it's convenient, it's available, the pleasure is on tap. And even if it passes, you can reach for the pleasure again fairly quickly with another burger. Whereas being at the gym, it's delayed or deferred gratification. The work will present itself in fantastic form when it arrives, but the yards are hard and they require discipline and dedication. So I think that's the behavioral wiring. And if you are selling low and buying high, by definition, mathematically, you are almost behaving in concert with the market, which means you are going with the crowd, and that is much easier than going against the crowd.
It's really that herd instinct that sees us swept up with momentum stocks, winning stocks. And if you speak to a trader, they say, "Oh, never go against the momentum." But what you've done is you've put a few investment arguments to the test with your Superdogs portfolio back in 1996, and you were looking for really good and sometimes great companies at unloved prices, so you were buying low. What were the criteria that you used here firstly?
Well, the criteria was, it started off really as an academic curiosity, and to put it into a sentence, the curiosity was, I wonder what would happen if I bought unloved but profitable companies. And to identify those, we built a portfolio diversified across the financial and industrial sectors of the Johannesburg Stock Exchange. The company had to be profitable, dividend paying with a viable balance sheet, but unloved, and we would identify that unlovedness by its low price earnings multiple, its high dividend yield, and the low price of the company versus its balance sheet. And out of that, built in that first year, a diversified portfolio of, well, to borrow from Buffett's appetite is for wonderful companies at fair prices. I think this could be the case of fair companies at wonderful prices. And that first year translated into an incredibly impressive result, a long way ahead of the market, which led to year two, and we've been going since then, 23 years later.
And it is a remarkable story. How many shares in the portfolio that you managed to sift the dogs from the duds?
We insisted, perhaps initially by fortunate accident, but now by design, that the portfolio is highly diversified. You will appreciate that if you're working in this type of terrain, it's inevitable that you will really buy some real dogs. And for that reason, we mitigated risk by insisting that the portfolio is highly diversified. So in year one, as many as 54 companies in the portfolio, making up sort of just 2% per company, which means if the idea is an absolute disaster, you're down 2%, you're not so far down that you can't recover it elsewhere. And that has been the case. Certainly, a fair number of mistakes over the years, but more than made up by businesses that have really shone far brighter than the market has priced them.
What sort of PEs were you picking these businesses up at?
Well, in over the years, the first year that we built the portfolio, For a 50 stock portfolio, we had a 6.8 price earnings multiple and a 3 dividend yield.
Wow.
Which is, it's quite staggering, for 50 stocks to have that type of average price earnings multiple. And we've continued to build regularly over the years, and that the multiple that I'm referring to are quite characteristic. So over the 23 years, the average price earnings multiple 7.3 times versus the market 16 times, which leads us to suggest that, if we're paying 7.3 for earnings and you're paying 16.2 for earnings, we're paying 50 cents in the rand for what are evidently good earnings.
And what has the Superdog strategy rewarded astute investors with over the last 23 years?
If you had built the portfolio and followed the investment strategy from 96 to now, the market would have given you 15 times money. This portfolio gives you 39 times money. That 39 times money is a wonderful result, but you'll appreciate it is a bumpy 39. That the downs are far deeper than your typical market down, and the up years are far more spectacular. So, by way of example, our biggest up year happened to be 2004, where the portfolio returned in that year almost 80%.
It's just remarkable. It really is remarkable, and it teaches us some valuable lessons for investing. One, obviously, being patience and being able to ride out those ups and downs. What else does the success of Superdogs teach us?
I think, it's about valuation, that one of the biggest catalysts isn't necessarily corporate action or an economic recovery or an industry change. Rather, that one of the biggest catalysts is actually valuation. You can load your portfolio with acres of valuation, and then I want to say all you have to do is wait, but that all you have to do is an incredibly hard all you have to do. The waiting is tough, and that requires then sort of a resilience and a determination to do the hard yards. And make no mistake, there are hard yards. I think the other thing that it also illustrates is that if the process is repeatable, you can place trust in that process and follow that process. Perhaps another aspect to throw in, you haven't flagged it, but I certainly will, and that is the learning by doing. That over the years, there are things that we've learned in building the portfolio, and that I trust translates into mistakes we won't repeat.
Well, without giving away too much of your IP, perhaps we can invite you back on to share some of those learnings at a later date, Adrian.
I'd love to do that. Thank you, Mike.
Super. That was Dr. Adrian Saville, CEO of Cannon Asset Managers, which houses the Superdogs Fund. Absolutely remarkable story in this week's Wealth Feature.